So let's go back to the four ways you can make more money. Number one was revenue, increase your prices. Number two was revenue, increase your volumes. Number three won't surprise you very much. You could reduce your costs. So pretty obvious so far. Essentially increase revenue, reduce the risks in revenue, or reduce your costs. What may surprise you is that as a manager of a finance department or as a finance director, I can't think I've ever looked to reduce costs or switch suppliers. Usually we're paying the prices we have to pay, which are either the market rate or where we are paying more, it's because we know and like the supplier. So you might expect cost reduction to be one of the first things an accountant does, but there you go. I've never really done it. So this section is going to be quite short. The one point I would make here is just review every transaction you have made every 3 or 6 months. I mean, like skim read the transactions just to ensure you're not still paying for a service which you thought you had cancelled or is now redundant because something else covers this. Again, this isn't even looking at the prices. So, gas, electric, broadband are obvious areas where you could get a better deal without putting anyone's nose out. Obviously, in terms of costs of goods, where you're paying a supplier, you would no doubt get better terms if you did bulk buy less often than if you buy smaller quantities more often. I can't imagine there's anything new to you there, though. Obvious reason why you wouldn't bulk buy less often is because you simply don't have the cash to pay for it or the space to store it. So what are some supplier risks? Well, the first has to relate to cash flow. I don't have the time to cover cash flow management in its entirety, but cash flow management is the most important part of your business. So your primary role as a business owner should be managing risk. Your primary role in managing risk should be managing cash flow. It really is as important as that. And remember, that is one of the key points of this talk, increasing cash and not necessarily profits, obviously ideally both, and reducing the risk. But these are the points I want to make regarding cash and how cash is unrelated to profits. So firstly, matching. Are you able to match your payment terms with suppliers to the same payment terms as your customers? If your customers will pay you in 60 days, and some do, are you able to agree, say, 60 days or even 90 days payment terms with your suppliers? So here's a very simple chart. We start with £200 in our bank account. We have to pay our supplier on 30 days, so we lose £500. And then in 90 days' time, we receive £750 from the customer. So all's well that ends well, but it doesn't exactly give us much money to run a business while I wait for that payment from the customer. I can't take a salary and I can't invest in the business. So if I could match the supplier terms to those I had agreed with the customer, I've got so many more investment options. And this ensures you're paid first and you will have enough money to invest. It's a somewhat silly and basic example, but it's true. So let's take the example of a yoga teacher. 6 weeks of lessons, £6 per customer per class. Let's just guess there will be 10 customers per class. The teacher will probably need to pay to hire a local hall for all 6 classes in advance. So let's say it costs £40 per session to hire a hall and you have to pay for 6 weeks of hire in advance. So here it is, forecasted. Here you might rightly say, okay, it's no big deal to pay this in advance. It's only £240. I mean, everyone needs to invest some money in their business, but this is just one class. The yoga teacher can't survive on £120 profit every 6 weeks. So how many classes can this person now put on before they run out of money? So two different classes would now be £400, three classes is £720. So we're approaching £1,000 now. It's the same line graph, but the overdraft fee is getting bigger. And the teacher can't pay themselves anything until week 5 in all scenarios. And the gamble is getting bigger too. So this is just one fundamental principle of this webinar, and fundamental in increasing your cash, maintaining your cash pile, and keeping you nimble, flexible with options. See, these big outlays of cash could relate to anything in your business like IT, office refurb, other fixed assets. So is there a means to schedule these big payments over the course of your operations? So I would recommend they either ask if they can pay for the local hall on a weekly basis after the customers have paid for each class, or ask the customers to pay for 6 weeks of classes in advance, or even better, both. And you know this is what a big and successful business would do. This very simply offsets the costs with the revenue, and you get paid first. In all cases, the teacher ends up with £200 in their bank, but only by matching receipts with costs can you begin investing back into the business immediately. There's a local advertising and sales agency in Bournemouth who pay their suppliers on the 23rd of the next month, but only providing the supplier submits their invoices by the last day of the previous month. So it's quite clever. Some suppliers, they get paid in 23 days, others nearer 53 days. So an average of 38 days. And you know what? They insist on payment in advance from all of their customers. They will not start a new project or campaign until they have received payment first. And I promise you, their customers are some of the biggest tech companies in the world. If they can do it, we should at least aspire to do it. More cash allows you to invest back into the business, invest in technology, automation, and efficiencies. More cash allows you to take a bigger salary and dividends. More cash attracts the best employees. It attracts investors and higher investment. It enables you to borrow more money at lower interest rates, and you become really attractive. The second risk is simply the risk within your supply chain. That is a key supplier or critical supplier that fails to deliver on their commitment to you. This is obviously overemphasized where that supplier affects your delivery to customers. So how can you mitigate these risks? Well, ideally, you should have multiple suppliers within your supply chain for the same products or services. You can then rely on one, if not the other. You may even be able to play one off against the other if that's how you like to run your business. But that's the end of part three. So let's go back to the 4 ways you can make more money and mitigate the risks.